You checked your investment account. The market went up 11% this year. You did the math in your head, that should be thousands of dollars. But when you looked at your actual balance, the number didn't add up. You sat there, staring at the screen, doing the calculation again. And again. Something was wrong. But nobody told you what. My name is Semzi. I help people understand money and take real control of their financial lives. And if what I just described felt familiar, that quiet confusion, that gap between what should be and what is, then this video was made specifically for you. Before we go any further, if you've never subscribed to this channel, do it now. Not because I'm asking you to. Do it because the next time I drop a video like this, you'll want to be the first person to see it. Hit the like button too, it tells me this kind of deep, honest content is what you actually want more of. And drop a comment, tell me what percentage of your portfolio you think is being eaten by fees right now. Just type a number. We'll come back to that. What you're about to learn in the next few minutes is something most financial advisors quietly benefit from you never knowing. We're going to talk about hidden fees, not the obvious ones, not the ones you signed up knowing about, but the invisible ones. The ones compounding silently, month after month, year after year. The ones that could cost you more than $100,000 over a lifetime of investing, and you'd never see a single bill for them. Stay until the end. Because the last thing I'm going to say might change the way you look at every investment you've ever made. Let's start with something most people never think to ask. When you buy a mutual fund, or even an ETF, you're not just buying a collection of stocks. You're hiring a team. Portfolio managers. Analysts. Compliance officers. Administrative staff. A marketing department. And guess who pays for all of that? You do. Not directly. Not with a check. Not with a line item you approve. It comes out automatically, every single day, as a tiny fraction of your total assets. It's called the expense ratio. And for many actively managed funds in the US, it averages around 1% per year. 1%. Doesn't sound like much, does it? Here's where it starts to hurt. Imagine you invest $50,000. The market returns 7% annually over 30 years. With no fees, you'd end up with roughly $380,000. Now subtract a 1% annual fee. Every year. You'd end up with about $243,000. That's a $137,000 difference. Gone. Not to market risk. Not to a bad investment decision. Just, gone. Silently. Automatically. Without a single notification. That's not a small number. That's a car. That's a child's college education. That's 3 years of retirement income. Taken from you, legally, because it was buried in a prospectus you never read. And we haven't even gotten to the other fees yet. Let me tell you about a man named Derek. Derek started investing at 28. He was proud of himself. Not many of his friends were even thinking about retirement savings yet, and here he was, already putting money into a managed portfolio his bank recommended. The advisor seemed knowledgeable. The brochure looked professional. The office had good lighting. Every year Derek checked his statement. It showed gains. Not spectacular gains, but gains. He assumed that was just how investing worked. Slow and steady. By the time Derek was 52, he finally sat down with a fee-only financial planner, someone who charged a flat hourly rate instead of earning commissions on his portfolio. Within the first 20 minutes, she showed him something that made his stomach drop. The fund he'd been in for 24 years had an expense ratio of 1.2%. Plus a 12b-1 marketing fee of 0.25%. Plus an administrative fee of 0.15%. Total, 1.6% per year. Every year. For 24 years. She ran the numbers. If Derek had been in a comparable index fund charging 0.04%, which existed the entire time, he would have had an additional $178,000 in his account. Derek had never missed a payment. He had never made a bad trade. He had never panicked and sold during a crash. He did everything right, and still lost $178,000 to fees he didn't know existed. This is not a rare story. This is the normal story. Now let's talk about something that almost nobody explains clearly. There are several layers of fees that can exist simultaneously in a single investment. Most people only know about one or two of them. The first is the expense ratio, the annual cost of running the fund, expressed as a percentage of your assets. This is the one we already talked about. It's the most well-known, but still widely misunderstood. The second is the sales load. Some funds charge you a fee just to buy in, called a front-end load. Others charge you a fee when you sell, called a back-end load, or a deferred sales charge. A front-end load of 5% means that if you invest $10,000, only $9,500 actually goes to work for you. The other $500 goes directly to whoever sold you the fund. Think about that. You haven't made a single investment decision yet. You haven't waited a single day. And you're already down 5%. The third layer is the 12b-1 fee. This is one of the most misunderstood fees in investing. It's a fee the fund charges you to market itself to other investors. Yes, you read that correctly. You are paying for the fund's advertising budget. And it's perfectly legal. It can be up to 1% of your assets per year. The fourth layer is the turnover cost. When a fund's managers buy and sell stocks inside the fund, which they do constantly in actively managed funds, there are transaction costs, brokerage commissions, bid-ask spreads, market impact costs. These don't show up in the expense ratio. They're embedded in the fund's performance. Researchers at the University of Virginia estimated that high-turnover funds can lose an additional 0.5% to 2% per year to these invisible transaction costs alone. You're not getting a bill for any of this. It's just quietly subtracted from your returns before you ever see them. And then there's the advisor fee. If you work with a financial advisor who manages your portfolio and charges a percentage of assets under management, or AUM, that's typically 0.5% to 1.5% per year, on top of whatever the funds themselves charge. So let's do the full stack. Expense ratio, 1%. 12b-1 fee, 0.25%. Turnover cost, 0.75%. Advisor AUM fee, 1%. Total, 3% per year. The U.S. stock market has historically returned about 7% annually after inflation. If you're paying 3% in fees, you're keeping 4%. Your advisor's fee-generating system is capturing almost half of your real return every year. And here's the psychological trap. Your statement still shows positive numbers in most years. Because the market goes up. Because your balance grows. You feel like things are working. But you have no reference point for what your balance would look like without all those fees. You can't see the counterfactual. You can't feel the money that's missing. Your brain wasn't designed to grieve money it never saw. Let me explain something about how your brain works, and why this keeps happening to millions of intelligent people. Behavioral economists call it out of sight, out of mind, and there's deep neuroscience behind it. When pain is invisible, your brain doesn't process it as a threat. Dopamine, the chemical your brain releases in anticipation of reward, surges when you see your investment account balance go up. It doesn't measure what you're losing to fees. It only sees the number on the screen. This is why people feel good about investments that are quietly draining them. The visible return triggers the reward system. The invisible fee bypasses it entirely. It's the same reason that free services don't feel costly until you realize you're the product. It's the same reason subscription fees compound invisibly until you see your annual bank statement and feel a sudden, quiet horror. The fund industry designed their fee structures to be invisible by default. Not because they're malicious. But because invisible fees don't generate complaints. They don't generate phone calls. They don't generate canceled accounts. They generate compliance. Here's a truth that might be uncomfortable. The financial services industry, as a system, is not primarily designed to maximize your wealth. It is designed to maximize its own revenue while maintaining your confidence. Those two goals are in conflict. And for most of the industry's history, they've been very good at resolving that conflict in their own favor. This is not a conspiracy. It's just incentives. When your financial advisor earns more if you're in high-fee funds, they have an incentive to recommend high-fee funds. When a fund company earns more with higher expense ratios, they have an incentive to justify those higher expense ratios. When the fee comes out automatically, invisibly, from a pool of money you only check quarterly, there's no moment of pain that triggers your decision-making. The incentive structure is built around your psychological blind spots. And the fee architecture is built around your cognitive comfort with invisible costs. Understanding this doesn't make you angry. It makes you dangerous, in the best possible way. Because now you know where to look. Let me tell you about a second person. Her name is Claire. Claire was a 34-year-old teacher. Not a finance person. She didn't read market reports. She didn't follow the Federal. But she read one article about index funds and expense ratios, and something clicked. She moved her retirement savings into a simple 3-fund portfolio. A total U.S. stock market index fund. An international index fund. A bond index fund. All with expense ratios under 0.05%. She didn't try to beat the market. She didn't pay for active management. She didn't pay an AUM advisor. She put her savings on automatic, checked it twice a year, and kept teaching. By 60, her portfolio had grown to $940,000. Her colleague Ryan, same salary, same years of teaching, same contribution rate, had stayed in the school district's default managed fund, which charged 1.4% annually. Ryan's portfolio at $610,000. Same income. Same discipline. $330,000 difference. The only variable was the fee. Claire didn't need to be smarter than Ryan. She didn't need to take more risk. She didn't need to sacrifice anything. She just needed to know one number, the expense ratio, and choose accordingly. Now I want to give you a framework. A simple way to think about this so you can act on it. The first principle is this: every dollar you pay in fees is a dollar that never compounds. This is the most important concept in this entire video. Fees don't just cost you what they take, they cost you everything that dollar would have grown into over the remaining years of your investment horizon. A $1,000 fee at age 35 doesn't cost you $1,000. In a portfolio that grows at 7%, it costs you $7,600 by age 65. Because that $1,000 would have compounded for 30 years if it hadn't been taken. This is called the opportunity cost of fees. And most investors have never calculated it. The second principle: the market doesn't owe you performance, but fees are guaranteed. When you invest in an actively managed fund, the performance is uncertain. The manager might outperform. They might underperform. Over the long term, the data is brutally clear: roughly 85% of actively managed funds underperform their benchmark index over 15 years, according to the S&P SPIVA report. But the fees? The fees are guaranteed. They come out whether the fund goes up or down. Whether the market crashes or soars. Whether your manager beats the index or gets destroyed by it. You are taking all the risk. They are taking a guaranteed percentage of your assets. The third principle: low-cost investing is not settling. It is the rational choice. There's a cultural bias in finance, a sense that paying more means getting more. That a 1.5% expense ratio means you're getting superior management. That a premium product deserves a premium price. But investing is not like buying a car or a suit. In those purchases, more money often does get you more quality. In investing, the research is clear and consistent: higher fees do not produce higher returns. In fact, the most reliable predictor of a fund's future underperformance is its expense ratio. The higher the fee, the worse the expected outcome. This is counterintuitive. And it's one of the most important things you could internalize about money. The fourth principle: your job is to minimize what you can control. You cannot control the market. You cannot control inflation. You cannot control geopolitical events. You cannot control corporate earnings. But you can control your costs. You can choose low-fee index funds. You can avoid unnecessary advisor commissions. You can read the fine print before you buy in. The people who build real long-term wealth are not smarter than everyone else. They are not luckier. They are ruthlessly focused on the variables they can actually control, and fees are at the top of that list. Let's talk about what happens if you don't change anything. Imagine you're 35 right now. You have $80,000 in investments. You're adding $500 a month. The market returns 7% annually. You're in funds that average a total fee load, expense ratio, advisor fee, turnover cost, of 2.5% per year. By the time you're 65, you'd have approximately $620,000. Now imagine the exact same scenario, but your total fee load is 0.15%. Just 0.15%. By 65, you'd have approximately $1,080,000. That's $460,000. Gone. Not to bad luck. Not to a market crash. To fees. That's not a hypothetical fear. That is a mathematical certainty, if you don't change anything. And here's what that $460,000 represents in real life. It's the difference between retiring at 62 and working until 70. It's the difference between leaving something to your children and leaving them nothing. It's the difference between a retirement with breathing room and one spent rationing every expense. It's a number with a face. With a life attached to it. The system doesn't hide fees because it's evil. It hides them because they're more profitable when they're hidden. And the best defense against a system that benefits from your ignorance is knowing exactly how the system works. You now know things that most people who have been investing for decades still don't know. You know what an expense ratio is, and why a 1% difference matters enormously over time. You know what 12b-1 fees are. You know about front-end and back-end loads. You know about hidden turnover costs. You know that the total fee stack can silently consume 2 to 3% of your returns every year, and that most people never feel it until it's too late. And you know the story of Derek. And the story of Claire. And what the difference between them was: not intelligence, not income, not luck, just fee awareness. Here's the uncomfortable truth I promised you. Most people will watch this video, feel it deeply, maybe even feel a little angry, and then do nothing. they'll go back to their portfolios unchanged. Not because they're lazy, but because inaction has no immediate cost. The account still shows a positive balance. The market still goes up most years. Life keeps moving. And the fees keep compounding. The pain of this situation is designed to be invisible. That's the whole point. But you've seen it now. You can't unsee it. So here's the decision you're facing. Path 1, you keep things the way they are. You stay in the same funds. You let the same fee structures run quietly in the background. In 20 years, you'll have whatever that math produces. And you'll have always known, in the back of your mind, what was possible, and what you chose not to do. Path 2, this week, not someday, not next month, this week, you open your investment accounts, find the expense ratios, and calculate your total annual fee load. Then you compare it to what you'd be paying in a low-cost index fund. And you let that number tell you what to do next. That's the whole action. Just look. Just know. The next step becomes obvious once you see it clearly. 20 years from now, you are either going to wish you had started seeing this more clearly earlier, or you are going to be grateful you saw this video today and actually moved. The question isn't whether the fees are real. The question is, how much longer are you going to pay them without knowing it?